Hello. The front cover of the Religare Health Trust annual report says continuing to deliver. But in actual fact, when you thumb through the document, you'll find that there is a lot to be said about the growth that the trust is looking to go through. It's a health trust, a business trust. In other words, it owns clinical establishments, 11 of them, and 2 hospitals, with 4 clinical establishments under development, more than 3,000 beds. If you look through the annual report, you'll find specific photos and more details on each and every one of those. But I suppose what's really remarkable about this is really the fact that Religare Health Trust is in a market, India, where there is a lot of focus and attention at the moment. The election is now over. The new government is in place. Everybody is looking to the new government to come up with more policies to improve, among other things, healthcare. And in the market outlook section of the annual report, we see quite a bit of commentary on that. On the one hand, there aren't really enough of these healthcare establishments to cater to everybody. The number of beds per 1,000 available in India are far below what the World Health Organization and others are asking for. But at the same time, we're seeing more companies come into this market to make up that shortfall. The positives are that there are a lot of private establishments now that are catering to the population, I suppose, that can afford the private health care. And therefore, that means that it's also drawing in people from overseas in order to then have, for example, interventions of sorts done in India where the staff and the facilities are available in these private establishments. Right? So you've got this diametric that on the one hand, they don't have enough beds for everybody, but the fact is that the private healthcare industry is alive and well. What's also interesting about the annual report is obviously some of the specifics of how this macro picture is playing out for Religare Health Trust. And we find this particular page with a lot of these financial statistics. Let me take you through some of them and take a look at some of the graphics that they've used. It all looks like the sort of things that you'll find in a hospital. Are you ready? Here, for example, we have these eyedroppers showing you where the profitability numbers have come in. And you can see that the net service fee and hospital income here, the bars are actually much exaggerated. They should actually be much flatter if we were to be really sticky about it, because the numbers are actually not all that much different. I suppose what's important about this particular chart is to see that their 2014 numbers did actually surpass ever so slightly what they forecast in the prospectus when they listed a couple of years ago. So I suppose that's the most important part. When we turn now to page 6, we see this in a slightly less graphic form. But what's most important here is this particular table, where you can see that there was a 1% increase, or rather a 1% surplus, shall we say, over and above what was forecast that was actually achieved. And you can see that in the middle there, net service fee and hospital income, the same numbers as we saw just now with the eyedroppers. What's noteworthy, though, about this table is one line up, and that is the total revenue. And what you can see there, the variance between what was actually achieved and what was forecast in the prospectus is a negative 0.8%. In other words, their revenue fell short of prospectus forecasts. But what you're not seeing on this table, because it's a bit too big and it would make the text too small, is that actually in rupee terms, they were actually up 1% on their prospectus forecasts. So here we can see the impact of the currency translation. The Singapore dollar has strengthened, the rupee in turn has weakened, and so the fact is that even though they've had an increase in rupee terms back in their functional currency of the Singapore dollar, that's why we've had that slight decline. Bottom line, though, still is that there was a 1% improvement on the prospectus forecast and the distributable income, and there the distribution per unit, you can see there, were in line with the prospectus. When we turn the page and we look at some of the commentary from the chairman and the chief executive, I've broken out this particular piece here where they say that the board is continuing its policy of hedging their cash flows because of these currency differences that we're seeing between the rupee and the Singapore dollar. And the board is continuing to hedge all cash flows originating from India 1 year ahead of the expected distribution payment to provide predictability and certainty. So clearly those hedges might cost some money in time, but in the meantime, at least, it provides shareholders with that certainty. And that distribution, incidentally, is so nicely graphically represented here with these rolled up bandages. You can see that the one at the top, the 2014 distribution, is substantially longer than the one at the bottom. 8.19 cents, though, is just a shade above the 8.17 cents that the prospectus had been calling for. So a big improvement of 4% over last year's distribution, but it is actually pretty much in line with what the prospectus had forecast. And when we look to the future, here's a very important point that shareholders need to know. Because Fortis Healthcare, which is the sponsor of Religare Health Trust and incidentally also operates its facilities in India, Fortis owns around 27.8 or so percent. Let's say 28% of the company. That's about 220 million units. And so once Religare listed, Fortis said, we're not going to take the distribution that would ordinarily be owing to us. They called it the sponsor waiver. They waived their right to the distributions for the first 2 years, 2013, 2014. What you as shareholders must now realize is that 2015, the financial year that's now underway, Fortis, as 28% shareholder, will want to receive its distributions. The distributions that are owing to it for owning those 220 million units. So what that immediately means is that we can see a fall in the distributions, because all of a sudden there's somebody else sitting at the table wanting their share of the pie. However, there are some offsetting factors, some mitigating factors, and we can read more about those on page 10, and I've highlighted them here for you. In conjunction with the expiry of that sponsor waiver that I was talking about, Religare Health Trust will commence receiving a higher base fee in addition to a 7.5% of the operating income of the Gurgaon clinical establishment. Gurgaon. That name will come up in just a few moments again. Right? So there is, in other words, something of an offset. Yes, Fortis will want its share of the pie starting the current financial year, but the pie should be bigger. And we see that here in this continuation. We expect the contributions from the increase in base fee as well as the variable fee following the stabilization of the Gurgaon clinical establishment to help offset the expected dropping distribution. So help offset, they weren't specific, and I couldn't find anything in there that actually gave a forecast as to whether it'll be fully offset or half offset or what the distribution will be. But in any case, it'll be help offset. Whatever that helping means would suggest that when we go back to our bandages from before, that perhaps the next year's bandage is going to be shorter than the one that we see there. But we'll have to wait until it's all wrapped up in the current financial year. There are some curiosities, really, some things to note about the Gurgaon clinical establishment, as well as the Mohali clinical establishment, because one of those things that might help offset the fact that Fortis is now taking its share of the pie is the Mohali clinical establishment, which should contribute a distributable income of about $1.5 million this year. Should contribute $1.5 million. But when we turn to page 112, in note 36 to the accounts, we read this particular paragraph. It's a bit small, so let me read out. It says that this Mohali clinical establishment, which they paid almost 60 million Singapore dollars for, they're assessing the purchase price allocation, and accordingly the financial impact to the group cannot be assessed reliably at the date of this report. So, on the one hand, they're saying the Mohali clinical establishment will contribute $1.5 million in distributable income. On the other hand, we read further back in the small print that there seems to be still some uncertainty as to what the financial impact of this acquisition is on the group. Perhaps something to ask about at the AGM. In relation to Gurgaon, there's also this particular snippet here, which you can find on page 78 of the annual report. And again, it's fairly small, this breakout, so let me just point out to you what it actually says. It points out that on the 17th of September 2012, so that's approaching 2 years ago, they agreed to buy the 51% in the Fortis Hospital which owns New Delhi, Shalimar Bagh, and Gurgaon clinical establishment. But since the 17th of September 2012, even though they've agreed to buy the Fortis Hospital, the application to buy it has been filed with the authorities, but is still pending approval. So here we are almost 2 years later, and it seems, again, looking at page 78, that they don't actually own that other 51% yet, at least not as far as the authorities are concerned. In the meantime, though, they point out that because the group is able to direct the relevant activities of Fortis Hospital, the group has consolidated 100% of the earnings. So again, this might just be a small piece of detail, but one which shareholders might want to look up for themselves on page 78. The fact that they announced this acquisition, it seems for all intents and purposes that the acquisition has gone through. After all, they have management control, and yet there is still that thing with the authorities still 18 months, 2 years later, not having signed on the dotted line, given their chop of approval. Perhaps something else that you might like to ask about at the AGM. The relationship with Fortis is obviously an important one. Fortis has recently consolidated its assets in other parts of the world, selling, among others, those in Hong Kong and Australia, to focus on India. And that's significant too, because when you read the annual report, you read a lot of detail about Fortis. I found this a little bit surprising because, after all, it's Religare Health Trust's annual report, and Fortis might be the sponsor, but it's only the 28% shareholder. But there's a lot of detail in there about, for example, the fact that Fortis has pared down its debt, and it's focusing very much on India. And that little section concludes with this part, that they look forward to working with Fortis on capitalizing on the growth in the Indian healthcare sector, with RHT, that is Religare Health Trust, providing the capital and health infrastructure facilities, and Fortis actually then operating it by providing the services. So the tie-up with Fortis seems very, very strong indeed, seems very, very close. Elsewhere in the annual report, they say that 87% of the receivables are due from Fortis, but that they have no concerns because of this close working relationship to be cashing in on those receivables in due course. But the fact that Fortis is so strongly on board obviously gives rise to the question of where the growth for Religare Health Trust is going to come from. How closely are they tied together? And we see those details on this page here earlier on in the annual report, where they talk about the growth on various fronts. On the left, it is organic capacity expansion, simply doing more with what they already have. In the middle is the right of first refusal of certain assets, and then there's the third-party acquisitions as well. So it seems very much, as I started saying at the beginning of this report, that Religare Health Trust is really all about that growth. And now that Fortis, its sponsor, is focusing on India, that the two will be working together more, it seems, on continuing to grow both organically and through those rights of first refusal to buy more of the assets locally. Now, how will it fund that, of course, is an important question. And that's where, once again, we turn back to the beginning of the annual report and those funky graphics they used, using the sort of objects that you'll see in hospitals to illustrate the case. And here we have a pile of pills. And the pile of pills on the left shows the amount of debt that they could take on if they had a credit rating from one of the credit rating agencies. In the middle is a smaller pile of pills, which shows how much debt they could take on if they didn't have a credit rating. And then on the one on the right is the bar chart, which shows how much debt they actually have. And according to this figure, it is gearing of 7.3%, $64 million worth of debt. So the overarching message from this screen is that they have ample headroom. In other words, they have a lot of scope to lend a lot of money in order to make those acquisitions that I was talking about before, taking on debt of more than $400 million if they had a credit rating, and even more than that, more than $900 million, more than $1 billion if they did get themselves a credit rating. So the debt seems to indicate that they have a lot of headroom. They have a lot of scope to take on debt in order to make sure that they can do those acquisitions. However, when you go along to the annual general meeting on the 24th of July, on Thursday at 4 p.m., one of the resolutions that you'll be asked to vote on is to allow the company to issue up to 50% more in terms of units. And so that obviously suggests that debt might be too bitter a pill to swallow. Perhaps they are actually going to look at not just raising money in the capital markets through debt issuances, but also raising money in the capital markets through new share or unit issuances as well.